Righto, buddy miners, we've got bloody a repeat guest here, Vas Piperoglou. I think I got that right. From Collins Street Asset Management. Mate, the gold... when we talked to Vas last time, when you talked to him last time, JD, they were in everything early, all these gold juniors. So they're probably bearing some fruit now. All those gold juniors... we'll be calling bloody Tim Taylor soon for a CBE power station when they mature into a producing operation. They're bloody one day closer.
They want to turn those hits into actual cold hard cash, mate.
Yep.
It's the logical next step to take, isn't it?
You need power to produce gold, mate. Last time I checked.
Mate, you need independent power.
You need independent power.
Independent power produced by bloody CBE, build, own, operate.
Build, own, operate. What an innovative solution to
Vas.
get into production and on low capex.
Vas, IPO these fellas. God, mate, give Timmy. Timmy Taylor's been getting pulled up at the airport. Hey, are you Tim Taylor from CBE? Twice in one visit, I heard. Give CBE a call. Right, JD. Mate, what a great time. They'll be, it would have been a bit cheery, the old Vas, I'd assume.
Yeah, I mean, it was pretty wild reflecting on the discussion I had with him a year ago, Matty. It was almost exactly a year ago, and a lot of the themes we spoke about when I had the chat earlier this week were, just how those narratives have played out. So gold, energy, the macro stuff like inflation, fighting deficits and debt and all those sorts of things. And I listened to the conversation that we did earlier in the morning and then was chatting with him before and obviously throughout discussion about all these things. And it was, full credit to the guys at Collins Street and Vas. It's gone more or less kind of how they thought, but looking forward from where we are today, it's very interesting to pick his brain apart and understand where he thinks the opportunities still lie. And to be clear on the gold part, they've reopened their fund, their special situations fund, as they set it up, as well as a part of their flagship fund. So plenty of opportunities, and it was great to pick the mind of a sort of hardcore value investor.
Righto, without further ado, let's just get into it.
All right, Vas, I'm super excited to speak with you again. I listened back to our conversation almost exactly a year ago, and it's fascinating to reflect on how many of the themes have played out, what the broader macro environment has done over the past year, whether that be inflation, excessive valuations in parts of the markets, and all these sorts of things. So I thought we'd just start the conversation by taking a bit of a temperature on the broader market, whether that be US, China as well, and Australia, and what you're making of the big names across markets.
So I think it's fair to say, whilst there was a little bit of a downturn recently, I think the Dow fell 10% from peak, and it's clawed back more than half. Some of the larger names, let's be honest, across multiple markets, whether it's Australia, the US, or anywhere, to be honest, some of the names are still richly valued, and so as value investors, as readers of the most recent history in finance, say the last 50 years, some of these numbers are still pretty elevated. And so, one of my, again, nothing against Commonwealth Bank, but I usually love to use that as a proxy. When Commonwealth Bank is trading at, 25, 24 times earnings, which I've never seen that anywhere in history, then it does get to show that the larger names in most markets are still well bid. I guess the question may be why, but the reality is they're still pretty well bid. And then if you go down the market cap space, there's a huge divergence, and I'm finding that obviously on the ASX, but also anecdotally in America as well. So you've got the small to mids that are out, when they're out of the indices and you don't have these ETFs and these passive funds buying, sometimes there is huge asymmetry. And that's just generalizing. Obviously, we're a pretty active, concentrated value investor, so I am talking my own book. But, right now at this point in the cycle, you would be a brave man or lady to be passive, in my opinion, in some of the larger names that have done amazing over the last, say, 5 to 10 years.
What is your view on passive more broadly? I mean, I'm so excited because there's so many directions we can go with this conversation, but passive, to what you just said there, has been such a fundamental driver between of those valuations, whether that be Nvidia, Combank here, and it's a large portion of every dollar that's getting invested these days is going. How does that unwind in your mind, if it does, or where does it go in 10, 20 years?
I mean, that's the $1 million question. I guess at the end of the day, passive can work both ways, right? So yes, in a rising market, and generally the markets are rising over the long term, it's obviously a beneficiary of the passive flows. But on the flip side, when you have some reverberations, it's normally indiscriminate selling. So where will it head in the future? I actually don't know. But from our perspective, if you keep it simple, right? If whether you're talking pretty much any asset class, you stick to the margin of safety. You've got a valuation, and then you have, I guess, a threshold of the upside or the return you want to make on a specific investment. And so, the margin of safety is just not there in some of the well-bid names. Australia is a little bit unique. I'm not sure if we touched it on last time, but our superannuation sector, our population is only 25, 26 million, yet we have trillions upon trillions in the super chasing some of these names. So, I find it as a value investor mentally tough, but it's something that we're just not going to go there at this stage in the cycle. But on the flip side, things can, the pendulum can swing the other way. And so, perhaps the next downturn, if there is a downturn, if this is the start of a market correction that, generally happens every 5 to 10 years, perhaps it's these passive ETFs or passive investors that will cause the opportunity in some of the larger names. But right now, it is a wall of money, and it seems to never end. But it is fascinating, and in 20 years' time, we'll look back at history and say, "Oh, that was obvious." But yeah, it's one of the conundrums I believe in modern day value investing.
To invert the sort of question for a moment, you guys are a boutique money manager here, and one of almost a dying breed in a way in Australia. There's been a real sort of gutting in that way of the market, whether that be moving to passive or pod shops in America, or all sorts of various strategies. Do you think the money managed in Australia by groups similar to you is a bigger value in 10, 20 years or smaller?
It would be fair to say, I think, look, let's be honest, it's been pretty difficult for the value type investors over the last 10 years. I would like to think it's not going to be much more than it is currently. I mean, one of the hardest parts about being a value investor, or a successful value investor, I should say, is sometimes it is a long time between drinks. And so, from our perspective, look, we're pretty boutique, we're pretty niche. We manage probably approximately 350 million under management. We don't really have much institutional investors. It's just individual high net worths. And so we don't have that. We feel like that rod on our back to have, month in, month out, 6 monthly amazing positive returns is not there. And so, I think it would be hard to do what we did with an institutional mindset. And again, I'm just throwing it out there. Platinum Asset Management used to be known as one of Australia's most successful international value fund managers. They've had a pretty tough time of late. And so, there are a few other large names that have just struggled from that institutional type money trying to be value driven, because of the market and because of the passive flow. So to answer your question, I don't think it's going to get easier. So I don't think there'll be much more boutique value guys, because it is tough. But, at the end of the day, eventually, when you're buying reasonable quality companies, or you pick a right thematic like gold and you ride the various bull markets, it does take time and perseverance. the same thing with our uranium thematic as well. Yes, we're value investors, but we're not scared of touching resources. When we had our uranium thematic, it was 3 years, 3.5 years before the stocks did anything. Now, I'm not sure how many institutional type fund managers are able to hold out for 3 to 3.5 years. I even had some robust debate with my business partner. Have we got it wrong? What are we doing? The stocks haven't moved. The spot price is up 35%, but we held through. So yeah, it's not easy, and I suspect those that can survive and wait it out for I guess the asymmetry that they feel is present. You're well rewarded, but it is not easy.
Yeah, and perhaps the opportunity lies in the fact that other institutional managers can't quite execute on it. I'm keen to go back to broader market dynamics and sort of ask you about excessiveness and sort of bullishness. It was a massive theme through 21, died sort of momentarily in the States and here through 2022, and it sort of came back quite strongly in particular parts of the market last year. Where do you kind of, if you were to take the temperature on fear and greed or however you might term it, where do you think we are?
I think, and I'm generalizing, I think today markets and opinions and the temperature move a lot quicker. Okay, so very bifurcated, and it can move in and out on any given week. And so if we hone in on specific sectors, I think, I could be wrong, but I think we're over the peak AI from a valuation perspective. Again, we never went long AI names, we never went short AI names, but if I'm trying to hone in on different markets, I think we're at peak AI.
It didn't really strike me as your type of investment.
No. But the irony about AI is I think it's an amazing technology, and I think it will be those that can capture it will be years ahead, 2, 3, 4, 5 years ahead from an efficiency perspective. But actually, I've yet to see, apart from Nvidia, I don't know anyone else that's actually making money. So if you can find out, please tell me. That's directly making money from AI. I don't think the business models really have been working out. So that's that market. On the flip side, if you look at the energy space, I feel like it's peak pessimism. And I am talking mainly about the oil and oil services sector. The fact that oil's gone from let's say $90 a barrel to high 60s. Everyone thinks it's the end of that sector, and so valuations are pretty depressed, very depressed. And then on the flip side, you've got precious metals where you slowly starting to see institutional names get interested in the sector. It hasn't yet fully trickled down to the small caps, but it's you're getting a whiff of green shoots, and so the market's very bifurcated. So I think the markets move a lot quicker than they do normally. I think generally everyone knows from a historical fundamental perspective, America, if I look at the American stock market, I think it's 40 or 50% of the world's market cap. Yet America's not 50% of the world's profits. And so everyone knows that it's pretty rich, that, in that part of the world. And then on the flip side, you look at some Asian nations, which include China. I do remember last time we had an interview. At the time, none of our funds had a mandate to invest in China, but personally, I was pretty heavy. And I find it fascinating how, again, this is another example, the market's opinion can change in such a short time frame. So I remember personally buying JD.com, which is like the Amazon of China. It was less than 12 months ago at price to earnings of 5 times, and now people are saying, oh, it's still a bargain, but it's up, nearly 100%. And yeah, sure, it's still cheap, but the market does move very quickly to the flow of funds. So now that people think the flow of funds might be starting back in China and Asia, there's kind of there's been a bit of fund flow, I feel anecdotally, to the cheaper part of the markets. And then on the flip side, sorry to go on. But Europe, no one wanted to know Europe. And then probably within the last 4 to 6 weeks, Europe now, because people think Germany is actually going to start spending, is kind of potentially the next growth market. So look, it's fascinating. Markets move very quick. I think everyone tries to think they're smarter than they are, and they try to front load where they think the flows will be coming, or going to, I should say. From our perspective, it's all about valuations. And so, Blind Freddy could have told you China was cheap 12 months ago. Europe as well. I've been saying for a while, I think Europe's, yes, they've got a lot of problems in the EU, but from a valuation perspective, pretty asymmetric, even though it's done okay over the recent. And on the flip side, America's pretty expensive. But then you got Australia. I'm still trying to work at our market. I feel like you've got the top 50, and then you've got everyone else. Huge bifurcation.
That just a factor of the super funds you referenced before?
I think so. I think it's a mixture of super funds, both, and also our franking credit system. So generally speaking, the larger companies are the ones that usually pay the nicer yields and the nicer franking credits. And so, because of our demographics and people chasing yield and franking credits, it generally dictates, kind of the larger type companies. So I think between those two things, I think there's a huge divergence. And so it doesn't mean you can't do well, again, buying the top 50 stocks, because, you would have done amazingly over the last 10 years. But, mean reversion does work over a long term. And so, again, sorry to pick CBA, because I do personally bank with CBA, so I love CBA. But I'm not sure what your IRR is going to be over 10 years, including dividends, paying 25 or 26 times earnings. And so, it's a weird market, very bifurcated, very industry and stock specific on whether the market loves it or hates it, and also regional. So it's, to be honest, all over the shop.
So Vas, what do you think of CRE insurance, mate?
Vas, you there? Where's he? Oh, he's offline. Bloody good question, JD. Let's just assume the answer is friggin' awesome.
I think with these guys, with CRE insurance, it is the logical assumption.
Vas is a value investor. Talk about insurance broking value. Like if they created an insurance investing fund, I think CRE would be the top holding.
Mate, Vas is the secret to his way of investing is protect your downside and expose yourself to a lot of upside. Well, guess what, mate? Insurance is literally going to help you do that.
That's like a double whammy.
Took the words out of my mouth, Trev. Protect your downside. Call CRE insurance. It's the, they should be in your speed dial, I reckon. They should be.
Vas, if you've reopened up that gold fund, mate, just CRE are into all sorts of hybrid things outside of the mining and energy industry. So could be worth a call.
Construction, infrastructure, but mining in exotic
Possibly
places.
fund insurance.
Also, if you're starting a mine, you should also call CRE insurance.
That's
just to be clear.
That's mainly what they do. But Righto, let's get back to it with Vas.
Maybe sort of focusing specifically on Australia for a moment, given that's the mandate, I believe,
Of
still.
the value fund,
Yeah, of the value fund. Do you think, bearing in mind the strong performance we've seen, there's sort of more opportunities now, or versus 1 year ago when we spoke?
So I think, again, generally, we don't see much of the opportunity in the larger end of town. Now, in the smaller end, yes. The question is, and it's always the $1 million question, what's going to be the catalyst? Okay. And so with precious metals, obviously we've seen a reasonable uplift in the gold price. And so usually stocks in specific resource sectors a levered play on the underlying commodity. So yes, gold's up, 40% in a couple of years. Yet some of these better run, pre-production plays, are only up 20% or 30%. So you could argue the asymmetry's gotten larger, even though they've done okay. The asymmetry's gotten larger on some of that end. So I still think there's huge opportunity in the small to mid in the precious metal space. On the flip side, we own a few industrial companies. I mean, I'm happy to mention names if you want to, but some of these names have had 3. I think one of them has had 4 profit upgrades in the last 18 months. Yet the shares, because there's not really much institutional ownership and brokers don't really follow it, the shares are lower than they are now than they were 12 to 18 months ago. So I think the company's trading at 5.5 times earnings, number 1 in Australia for its sector. Yes, it's a small cap, but after 3 or 4 profit upgrades, so there is opportunity if you are willing to look under rocks. Obviously, the only downside, even if you get it right on a small cap, the downside is obviously the liquidity. It is harder to buy a meaningful position on the way in, and obviously it's harder to get out. But I do believe if you're willing to play in the slightly less liquid space, there is a lot of opportunity.
I know you and Michael are sort of big fans of Munger and Buffett. Are you guided by the thinking that in the long term the stock will follow the earnings? Does that kind of ring in the back of your mind?
Yes, and historically, obviously Collins Street's been around for close to 10 years, and historically that has usually been the precedent. Stocks usually follow earnings. I will say, though, this is the first time I've witnessed for such a long hiatus. For example, I think I bought my first share when I was 12. It was CSR, had the sugar and the building division, go figure. But I've never seen a company have 4 upgrades and the shares be lower than they were before the start of the upgrade cycle. So this is pretty extreme. It's pretty unique. I don't know what the catalyst will be specifically to change the market's perception of some of the smaller industrial companies, but the pendulum will swing eventually. But it is pretty extreme. And so again, if you're willing to play in that smaller end of town, there is huge opportunity. On the flip side, I think a lot of the easy money has been made on the larger end, being passive. Obviously, there are always outliers. And so, yeah, it's this weird market, and I, obviously we read, was it the other week that Buffett, further increased his cash position. Again, I am talking my own book, but I would like to think if Buffett was an Australian investor and he only had a couple of $100 million instead of billions, I have no doubt he will probably be playing on the smaller end of town, where there's huge value. And I think originally when he started his investment partnerships, he was buying, small caps that were trading at 3, 4, 5 times earnings, having net cash, good management. And so, yeah, right now that's where I believe, if we're talking Australian specific, where the opportunity lies.
Driving a return when you've got $350 billion can be a whole different sort of challenge that I'm not quite familiar with. Yeah. Before we dive in, I want to tease out the company specifics a bit longer to get your thoughts on interest rates. Obviously, a fundamental driver, and there's always, a couple different views in the markets. Now is no sort of different. I think you said last time we spoke that you're in the camp that interest rates would maintain a sort of higher average than the previous sort of 10, 20 years. Are you still in that camp?
I am, yep. So I think structurally, we are in a higher for longer camp. Now, it doesn't mean rates won't reduce. I mean, we've already had our first interest rate reduction, but, I think naturally, if you believe inflation, I get it, it's all kind of linked to inflation. If you think inflation will be structurally higher for longer and we ain't going back to the 0% world, then you have to assume that the inverse will be to keep that in check, that interest rates do need to be higher for longer. And so, you've got to separate Australia from the rest of the world. I mean, globally, if you think about it, there's a lot of debt out there, right? And at the end of the day, that needs to attract capital. And, there is a bit of a flight. And so you could argue that, again, just like commodity cycles, just like stock market cycles, there are interest rate or bond cycles. And I can't fathom a world where rates go back to 0 or 1% or 2%. I think they will be higher for longer. But you got to define what does that mean. It means higher for longer than the last 10 years. But if you look over the last 50 years, right, it's still probably less than the average. I remember maybe 10, 15 years ago, before rates, basically got to zero, the average Australian interest rate over the last 20, 30 years, like 7% was kind of the right figure. Obviously, I'm not talking about the early 90s where they were double digits. And so, if interest rates are 4%, again, historically over a long period, it's not that high. But yeah, sure, it's certainly higher than the last 10 years. And so I think consumers, investors need to get used to it. And selfishly, it's actually a good thing because it means people actually need to look at valuations. And really look at cash flows and look at your IRRs, and it kind of a little bit of a level playing field. As much as I am bagging the current disconnect in the market and how expensive it is, there is opportunity now as opposed to when rates were zero. It was pretty difficult.
Fundamentals actually matter. Yeah. Yeah, I wouldn't hold my breath, but no, it does seem very much like we're heading more to that world, and the opportunity set is much more interesting. Some of the bigger headlines we've seen lately, maybe not quite tariffs. I don't think we need to go there because everyone else has kind of spoken about it ad nauseum. But I am interested to hear your thoughts on the US deficit and how that relates to debt. And then I think we can sort of make our way into gold, because I think that with the freezing of the Russian assets are obviously the key catalysts.
Sure. So I think everyone agrees, doesn't matter which side of politics you are, that America's trajectory is unsustainable. You can't have a deficit of 6 or 7% of GDP during a non-recessionary environment. Like, it's pretty crazy. Like, can you imagine any other country in the world having those numbers? You would point your finger and say that's the next Zimbabwe. So everyone knows it's unsustainable. The question is, what are they doing about it, and how effective will they be? So I think conceptually, on a longer term basis, on a high level, and this is my opinion, just as a bit of an economist, I think what they're trying to do, and when I say they, I'm saying Trump and his lieutenants, I think what they're trying to do structurally is the right thing, in so much as reduce expenditure, try to reduce the deficits, try to bring back some manufacturing, and not be so reliant on other nations. I think the issue they're going to be facing is there's never such thing as a free lunch, right? So if you're going to achieve some structural reform over the medium to long term, there has to be some short-term pain. And so I feel like the issue they're going to face is some of the impediments and the lobbying over the short term, because it is in conflict with Wall Street. And so I have noticed a lot of companies, and I can give you two examples, Nike and FedEx. So they came out and reported reasonable quarterly results, but when it came to their commentary on the current month or current quarter, they painted a pretty dire picture. So from what I've gathered, in March, the consumer in March, and again, we haven't finished March, in the US, is basically frozen. And I think it's just because of the uncertainty. So at the end of the day, what they're trying to do, I think, is the right thing. But the issue is, I don't know if it could be done over 4 years, or is it 5 years, the presidential term? 4. So, I don't think it can be done over 4 years. Something like this, you need a decade. And then on the flip side, can they wear the short-term pain by Wall Street, by the companies, by the CEOs? So that's a bit of a to be determined. On the flip side, you have to understand that if over the last 40, 50 years, if one of America's largest exports, not many people talk about it, but I mean, you read about it and you're aware of it, has been the US Treasuries. And so if the US dollar has been the world's reserve currency, and it still is, but if it's losing its market share, right, and then both friends and foes of trading partners to the US think, okay, well, what are we going to do with our US dollars? Are we going to recycle it back into treasuries and US assets, or are we going to maybe reduce slightly how many treasuries or US denominated assets, which may include US shares, by the way? I don't know why people don't talk about, it's not just treasuries that foreigners own to recycle US dollars. I think another beneficiary has actually been Wall Street and the NASDAQ. And so, there's a lot of foreign capital in the stock market as well. And if they want to reduce some of their holdings in both treasuries or US denominated assets, then one of the beneficiaries, I'm not saying the only beneficiary, is gold. And I think we're seeing that. I think it started, as you said, when US and Europe froze Russian assets. It continued. It even continued, let's be honest, when rates went from 0 to 5%. Historically, that would have been the very bearish precious metals. The fact that gold didn't collapse just shows you the physical, real demand out there. And yeah, sure, we didn't pick that Trump would be in office and start all these trade wars. But again, he's just continuing something that, to be honest, was started with Biden. And so clearly there is a bifurcated world. Clearly there is geopolitics between the Sinosphere and the US sphere. And so naturally, again, I don't know what the outcome's going to be of the US efforts to reduce the deficits. I mean, we're talking about, you've got to remember, we're not talking about America going from a deficit to a surplus. We're talking about America reducing their deficits. And so it's still not that good. But I guess if they can succeed in reducing the deficits, it's not as bad as the status quo. And so, I think naturally, precious metals have a big part in diversifying away from USD assets. And then on the flip side, as a value investor, at the end of the day, you can still have a market that is growing, but if their asset prices are crazy, like all the AI crap, you're not going to make much money. On the flip side, precious metals, now whether they're producers, developers, or explorers, they're still pretty cheap. And so you kind of got both tailwinds. You've got the geopolitical tailwinds, you've got the commodities going up, and you've got the asset prices still cheap. It's kind of almost too good to be true.
Yeah, there's a lot of privileges with having the world's global reserve currency. It's a very fine balance they need to tread over the next few years.
Correct. It's a bit of a conundrum, right? Because right now they still need foreign capital. They still need to be somewhat attractive. But on the flip side, they're kind of saying, well, you can't rely on us and don't expect all these privileges. So it is a fine balance. It's certainly a change that the world hasn't seen in a long time, probably since World War II. And I think the market hasn't fully grasped the second and third tier effects. I mean, it's obvious what the first tier effects is, but I don't think the market's fully grasped the second and third tier effects. And, you would be silly to not think about how that may play in some of your asset allocation decisions.
So the gold setup is just fascinating. It's almost endlessly fascinating right now for a variety of reasons. So you guys set up, to sort of explain to the listeners that aren't aware, this special situations fund 2-ish years ago.
Yep. It was just over 2 years ago.
And that encompassed explorers, developers, producers. You had a mandate to go international as well, as I understand it, purely for this opportunity. And like you said, this is before the gold price ran up 40%. I'm curious just to quickly get your thoughts on the other funds entering this space. We've sort of seen in recent times a number of, in your case, reopened, but other generalists opening gold-specific funds. And there was a comment you made when we spoke a year ago that really sort of stood in my mind, that when things get popular, we tend to run away. How do you marry up those two data points?
Yeah, generally I say when the money men come, we're out. So Yeah, so you're referring to obviously other funds like L1 Capital, I think the Smorgon Group, and ourselves, obviously reopening just for this month. It's just a one-off reopening. We're not keeping it open forever. Look, yeah, so my contrarian streak in me, there's a bit of a red alert. Well, oh my God, if people are opening funds, does that mean it's the end of the opportunity? I don't think so. And so if I look at a lot of our positions and even positions we don't own, they still yet haven't really trickled down to the small end. And so, you just Google Collins Street Asset Management and gold, and you'll see the dozen or so small cap stocks, gold stocks, where we are substantial shareholders. So it's in the public domain, but we're kind of the only institution. I'll get worried when I see Paradise substantial in all these names and L1 and all these other, I guess fund managers. But, for the time being, those fund managers you mentioned are really at the larger end of town. So it hasn't really trickled down yet. And on the surface, obviously we are fund managers, but we do speak to our clients, and we have, I think we have over 1,000 high net worth clients, and they're not really, I don't believe, all there yet in the sector. So I think, if I had to think of where we are in the cycle, I think we're probably halfway through this bull market.
Do you have a timeline on, because I know it's a special situations one and you've previously had a timeline.
Yeah.
How do you think about that?
Yeah, so the mandate was 3+1, so effectively 4 years. We're just over 2 years. And so I'm not saying I think we're halfway just because we're halfway in our fund. There is a bit of a method to my madness. And so I kind of reverse engineer the historical bull markets, and the last 3 gold bull markets, and again, I'm just rounding numbers, from the gold price trough to peak, the lowest return was 5x. So I believe from trough to peak over the last 3 gold bull markets, which spanned over the last 50 years, the average gold price increase from trough to peak was 5 times. Now, in this cycle, the low was about 1,000 an ounce. Okay. And so 5 times is 5,000 US. Now, again, that was the lowest of the last 3. The last 3 didn't have the geopolitics that we're witnessing now. The last 3 didn't have global trade wars. The last 3 didn't have US as the superpower that is slowly losing its dominance. And so you could argue this should be the greater of the 3. I'm just being conservative. I'm picking the lowest. And so, if gold is 3,000, and I think we're halfway, well, probably a bit more than halfway there. And so we will inverse the problem. If gold hits above, say, 5,000 to 6,000 US, we'll probably very imminently decide to start liquidating and closing the funds. Or on the flip side, if some of the stocks, the DCFs, so this is kind of what we did with uranium, if the DCFs on some of the listed companies we own, whose mines aren't built on the smaller end, if the DCFs predict and they go through the roof and the stocks are trading at massive premiums to the NPVs of the mines, then we'll probably start to reduce. And so, at the end of the day, it's 2 years into the fund. I think we're up slightly over 50%. It's okay, but it should be up a lot more if you believe the equities are a leverage play on the commodity.
And commodity price aside and the valuations you just mentioned, what are the other kind of signs you look out for the top to be in?
So historically, silver. So I've got a little note that I read every month. Silver historically usually goes crazy towards the end of a bull market. The poorer cousin. And so that's another sign I'll be looking at. Obviously, as you said earlier, when you start to see substantial shareholders in multiple fund managers and even in the small end of town, or you you start reading about it in the newspapers every day, or I don't know, it makes the front cover of Time magazine, maybe I'll get a bit nervous. But we're not there yet. Obviously, there will be a time. I think from our perspective, we're usually early in and we're usually early out. So just because Collins Street's selling at some stage in the future doesn't mean it's the end. It's kind of how we roll. I remember uranium, we made, I think, a bit over 4 times our money, and then we left 100% on the table. But then I looked at some of the stocks now, and it's pretty much where we sold. I think a lot of the uranium names have fallen.
Pulled back massively, yeah.
Massively, and so we just try to use simple maths. We use DCFs, MPVs, and when the stocks are trading at premiums to an unbuilt mine based on an MPV of of their feasibility studies, and a mine hasn't been built, so you're not even taking into consideration dilution, equity risk, funding. Usually it makes sense to take some profits. So yeah, I could be wrong, and obviously past performance is not a reliable indicator, but I'd like to think we've still got quite a bit to go in this thematic.
How about M&A? So I think in the last 6 months alone, Equinox, Ramelius, Northern Star, Goldfields yesterday had a stab. That's all sort of par for the course.
It is. So to understand why, I mean, conceptually, so one of the reasons what got us interested in the thematic in the first instance was the decade or so of under exploration. And so, that's from a supply side perspective. And so at the end of the day, there has been an under exploration for over a decade in drilling and replacing ounces in the ground. And so I think because equity prices, and this is my opinion, but because equity prices are still pretty cheap and reasonable, it is cheaper and more effective for a large peer, instead of wasting time and money drilling, is to make a play, an M&A play. And so, yeah, I think we'll continue to see this. Obviously, most of it's script-based. Sometimes it is cash, but most of it is script-based. And so, yeah, I think it will continue while the prices remain still pretty reasonable, as in the equity prices. And so, yeah, it's definitely a healthy sign that M&A is ramping up.
Your comment on supply there is really interesting, because gold, I haven't traditionally thought of supply and demand being more a financial asset. Do you think of it that way, or do you think more of companies maintaining their production profile and just topping up so they don't have the sort of supply to fill that gap?
Yeah, so when I say under exploration, it really is to replace what they're producing. It's nothing more complicated. It's not kind of on a high level the world's demand and supply factor. It's literally looking at. I mean, I remember 20 years ago when I was looking at gold stocks as a novice, not knowing what I'm doing. Like you'd look at some of these mine reserves and they'd be like 10, 20 years, and now they're like 2, 3, 6, 8. Thinking, well, fuck, what have they been doing? They just haven't literally been replacing what they've been producing. And you could say, why? Because effectively, up until now, they haven't had, the markets haven't given them much fundamental value for extending reserves. Like maybe the markets were more interested in loss-making IT companies, and it's similar to the oil and gas space, right? It's like, why are American shale producers, for example, concentrating more on paying out dividends and buybacks as opposed to extending the reserves on their assets, which deplete very quickly? It's because the market doesn't give them the benefit and apply an applicable multiple to growing their asset base. And so gold's kind of been in that. Obviously, it's starting to change now, but because they weren't getting the benefit of, replacing, extending asset lives, they just haven't. And so, yeah, it's literally replacing ounces in the ground on gold they've produced.
Incentives just driving outcomes again, I
Yep.
think. Some of the specific names I noticed you're holding or held at least at 31 December, I think, were in Australia, Black Cat and Catalyst, are they ones you're still sort of holding? I know we
Yep.
touched on Catalyst just before.
Yeah, so we do still own quite a bit of Catalyst, Black. I mean, you know, the ones that have done amazingly, obviously the ones I'm happy to talk about. No, the
Naturally.
the three ones that have done very well, and we've ridden them pretty well, and we're still reasonable shareholders. Is Catalyst, Black Cat, and Mika. No coincidence, all of them are either in production or about to be in production. And so the market obviously is getting excited about seeing cash flows. It hasn't yet trickled down really to the explorers. And so, so they're kind of the larger small names, if you want to call it that, the larger small caps that we own and have still done well. And then if we trickle down, again, we've still done okay, but they haven't gone up as much as some of those other names. Brightstar, we own a bit of Brightstar. It's well run, and it is a bit of an M&A play in the Sandstone region. Barton Gold, we are substantial in Barton Gold. We own AUN, AUN, just another sandstone play. And some of the international names are usually a little bit larger. So Aris Mining, ARIS is the code. Equinox. We do have a silver play, Discovery Silver. I think they recently signed to acquire a project, a Canadian silver project. They also have a Mexican project. Not sure how that's going to go with the tariffs. And so, we haven't really turned our portfolio over a lot. I mean, we set up to find the better quality small to mids. On the small end, we tried to really reduce the risk by honing in on management that have hopefully been there and done it before. So they've been through a previous gold cycle. They know how to bring mines into production. And so most of our pre-production plays, we actually generally feel they will get into production in this cycle. And so, we haven't really turned over the portfolio much. Obviously, we've been adding along the way. But it's, I mean, from the ASX perspective, there's probably 14 or 15 names on our list out of the whole gambit.
And you referenced a few North American names there. Huge trend for those guys to come and list here, not just in the gold space, copper and the like as well. If you look at them sort of on the balance right now, do you see more value in North America still? I know that was a big narrative a year ago, 2 years ago. How's that sort of playing now?
I think the mid caps in North America have actually caught a bid. So they're not that asymmetric as they were 12 to 24 months ago. On the smaller end, I think the answer is yes, but there's a caveat. If you are going down the smaller cap space, you've got to be very careful about management, very careful about the status of the project, the local jurisdiction, the permitting, obviously. And so because we're not on the ground in North America, we've tried to avoid the real small caps. But I can see a lot of them haven't really moved or haven't done that much. And so naturally, I think there probably is asymmetry in the smaller end in North America.
On energy now, energy is fascinating. Obviously, it's integral to our lives. And as we spoke about last time, the dynamics with ESG and everything shifting, I think that sort of the trend has continued in the manner it was going when we spoke last year. But here in Victoria, there's pretty imminent kind of concerns about energy prices, and that runs up the sort of eastern seaboard here. And the one name you hold that sort of plays in with this is Beach. You've also got a WA play we can talk about in a second. To start with, at a kind of, I guess, policy, we don't have to be political, but it ties in directly with the narrative of why you hold the company, I'm quite sure. What do you make of the situation here in Australia?
Fascinating. I think very short-sighted, and at the end of the day, if I think what we're witnessing is finally some common sense, in so much as everyone, at the end of the day, if you live in a democratic Western country, you want to have affordable living, and energy is part of living, right? And so if you can't even do that basic, having affordable energy for day-to-day living, then you are at a disadvantage. And so, I do feel the narrative's changing a bit, because it's hitting people and businesses' hip pocket, and obviously people vote. And so, yeah, I think the narrative's changing. I do think we need to move quicker. And so, without getting into the politics, I think we need to move quicker, but I'm getting the feeling that they understand, the politicians understand, that if they don't do something to fix it, it's going to cost them votes. And so, at the end of the day, I think gas, if we're talking about gas specifically, clearly that is a energy source that is less, it's still a pollutant, but it's obviously less than other means. And so, if you want to ban coal, right, you do need other alternate baseload sources, and I think gas is clearly one of them. I think it's very short-sighted that this country, to be honest, hasn't really had the proper debate. Like, I know Dutton said he's for nuclear, but I hope he means it. I don't fully have confidence that he does. He's just saying it to be different. But there hasn't been a proper debate on the long-term benefits of nuclear power in this country. We dig up the dirt and we just ship it overseas. Obviously, it gets enriched overseas. Why can't Australia have nuclear as a small part of its energy mix? And especially, in 10 or 20 years, if these small modular reactors come in, to me, it makes sense. So, yeah, I think the politicians they're aware of it now. They know it's going to be a big issue for them. The question is, are they going to move quick enough to actually make a difference? Whereas previously they weren't really aware of it. So, yeah.
Yeah, it's a super complex one. To tie it back to Beach, and not just Beach really, all the ASX names. I'm sure you're more than aware of how things played out with the coal names in Queensland, and the changing of the goalposts after the fact, and
about the royalties and all that.
Yeah, exactly. Yeah. The royalties after the investment has been made, which is obviously not what any mining company wants, and you can sort of say the same for an energy type company. Do you have concerns about that? Should there be profits, given what has happened, that those profits might not fall to the bottom line?
Yeah. I think generally you would be silly to not have concerns about government anywhere in the world, whether it's America or Australia, changing legislation after the fact. Because at the end of the day, all investments are made based on certainty. I said to someone in the office today, it's not that the negative outcome, if there's a negative outcome, a negative tax consequence or something, right, at least that can be factored in your original decision, right? And everything can be worked backwards. But making new rules after the fact, I do believe is a risk. It's a risk here. It's a risk in America, but it does seem to be increasing. And so, Australia has to be very careful that, the world is very competitive and is very globalized. We need to be very careful with some of the decisions we make. And if we are a trading nation, right, and we want to keep to attract foreign capital, we shouldn't be doing things such as that, what they did with coal to dissuade foreign capital from coming in. So yes, it's on my mind. Can I directly do anything about it? No, but you need to be aware that things can change rapidly.
Another part of the energy market that might be even more interesting than just traditional oil and gas and coal is the offshore services play. And as we touched on before, this is one of the special situations funds that you set up. The investment went to plan, 23, 24, you guys returned some money. And then a lot of these names, often US listed names given MMA, Offshore, got gobbled up here. Valaris, Bor, Noble, Tidewater, all these sorts of guys have really peeled back. And I think there's a part of this discussion that relates to the pod shops and the current way of the market that is super, super present here. We're talking about 10, 15% plus short interest. Do you think about reopening this fund?
So, look, never say never. It's not on the top of our agenda. And so the life cycle of the fund is, so it's been over 3 years. We've returned most of the capital to investors. So off the top of my head, I think the IRR's unlevered. We're about 27% annualized for the fund. We've returned pretty much most capital to investors. There was some investors where they actually said, don't give us the money back, we want to stay in. So we have extended for 12 months, but the fund is, it's kind of like, I think 80+% less because it's just a handful of investors that stayed in.
So more than 100% of the capital was actually...
Yes, so it was 125% of the capital approximately was returned in cash. And then some got a little bit more and then some decided to stay in. Look, the offshore oil services sector, it's bizarre because some of the stocks have nearly halved. The oil price hasn't halved. So I got Michael to look at a chart over the last 12 months. So I think we looked at a levered, so a 3 times leverage oil, so Brent ETF in America, so 3 times leverage. And that basically mimicked the moves in the offshore oil name. So they're obviously a levered play on the oil price, even though their earnings pretty much year on year for all of the names have gone up. I think consensus is for earnings to continue to be going up next year and the year after. I think what happened was the old consensus from 12 months ago has just been pushed forward a year. So the old 25 numbers, right, is now the 26 numbers. And it's, from what I gathered, it's just slight delays in various projects. Or on the flip side, even if the projects wanted to go ahead, there's been delays in engineering or other auxiliary services that relate to the drilling, because offshore oil is still one of the cheapest sources of oil globally. And I think most pundits expect oil to be with us for many decades. So it's it's not a question of will oil not be needed in 5 years. I think it's just the fact that the oil price fell from, say $90 to high 60s. Obviously, that didn't help the sentiment, some of the deferrals in the sector. But if you look at the earnings they're trading at, it's, again, they're pretty cheap. So would we reopen it? It's not high on the agenda, but you have given me a good idea.
How do you think about a catalyst to send it that? Like, is it purely oil? As you said, that seems a bit short-sighted given the moat, if you like, that these businesses have with the sunk money, sunk capital into the bits of kit, the ships. They are $1 billion at times plus bits of kit.
I think the two catalysts will either be time. I mean, you could argue as long as the oil price stays where it is, even if it drops a little bit, as long as it doesn't go much below, say, $50 or $60 for a long period, because there's no supply of these drill ships, and at the end of the day, these oil companies need to replace their depleting reserves, or you could argue need to replace a lot of the depleting reserves, especially knowing their shale wells deplete at 70 or 80% per annum. So the global depletion rate is higher now than it ever has been. So I think time will fix that, because as time goes on and there's not much supply of these rigs, naturally I feel their day rates will just continue to trickle up. I mean, I believe their day rates will surpass the previous high in the previous market, especially now that inflation isn't zero, and customers, I wouldn't say are happy, but they're willing to accept increase in prices. So time helps also in an industry that's consolidating. I still think there'll be more consolidation. I mean, there's already been consolidation, but I still think there'll be more consolidation. I think, again, I don't know how true or not it is. There's rumours that someone's going to make an acquisition of Seadrill. Whether that's Valaris, whether that's Noble, I don't know. So I think time, and then on the flip side, so it will sort itself out in a couple of years anyway, even if the price stays where it is. Or on the flip side, if the oil price starts to go back up, as I said, their earnings went up year on year, but because oil fell from $90 to high 60s, there's been a pretty big move in the stock prices. But granted, as you said, I have read about a lot of pod shops as well shorting, so that the shorting is pretty high. I mean, it doesn't worry me. I've made plenty of money in plenty of industry sectors, companies where the short interest is high. But yeah, it's fascinating. It's fascinating the market's love affair towards sectors, and then within 6 to 12 months, it's the diametric opposite. But that's the opportunity, I guess.
Yeah, absolutely. Time for your investment style is not really a problem, and M&A, consolidation, free cash flow.
I mean, one of our advantages is arbitraging time. Simple as that. I mean, I don't know how long certain things will take, but if you can think a little bit longer than the average TikTok punter, you can do okay.
Absolutely. I had a couple sort of general investing type questions to ask you, Vas, before we wrap up. And the first one I've been curious about since we last spoke is your investment philosophy and how it changes over time. I know you're a massive sort of Buffett and Munger fan, and have learnt a lot in that sort of school of thought, that value investing style. And obviously there's a key moment that they speak about in their sort of evolution of really going for quality names over cigar butts in general terms. How do you think about that in your perspective? I know I'm sure it's something you would have thought about.
Yeah, sure. Look, again, I think you have to take a view on which markets we're talking about. So if you talk globally, I feel generally globally, if you're agnostic to the geography and you can hone in on unloved geographies, such as China was 12 months ago, you can really look at some of the amazing, if you wanted to call Buffett type A1 quality companies, long-term compounders. I mean, who wouldn't want to buy the Amazon of China at 5 times earnings? It's kind of a no-brainer. But on the flip side, the ASX is a bit of a different beast. It's not often you get to buy high quality, durable, long-term compounders at reasonable prices. Now you could say, is that because of the weight of money in the super funds? Is that just for a very, very top-heavy chased market? I'm not sure. And so we've had to adapt along the way. And so I guess from our perspective, whether something is a cyclical, whether it's a turnaround that you have green shoots, so you're not predicting a turnaround, you're seeing a turnaround, whether it's an asset play, whether it is, sometimes we do takeover plays. We consider low risk takeovers. You could argue there's only 4% on that particular trade, but the IRRs can still be pretty substantial. And so we've kind of had to have a few ways that we can find asymmetry. Obviously, if you had to pick the ultimate type of investment, then sure, it's those amazing quality businesses or brands where they have one-off issues for some particular reason, and you go in hard. I find on the ASX, generally those opportunities come on a wholesale level when there's global uncertainty. So, the two that come to mind where, again, Collins Street wasn't around then, but where I profited from was GFC. Clearly, you could buy quality Australian companies at discounted prices. And on the flip side, for Collins Street Value Fund, we did do that during COVID. So when there's global macro shocks, there's usually opportunities in the larger end in Australia. Other than that, it is a difficult place to navigate.
Last question is on governance in Australia. We've seen some fantastic collapses in sort of governance, or maybe the revealings of poor governance standards in Australia. And obviously they catch a lot more headlines than the, phenomenal standards that other companies have set over just doing what they do day in, day out. But what do you make of governance standards across Australia at the moment? And I know you prioritise high quality management above a lot of other things, tied in with valuation and these sorts of things. But where do you think we sort of stand in Australia against US and other sort of similar markets in the West in our governance standards?
I think, look, to be honest, I think we're kind of on par. I suspect America and Europe, they have their own headline events. They have their own wise techs of this world. We just probably don't know about it.
Keeps things interesting.
It does. Look, I think at the end of the day, I think obviously it sells headlines. It's good for the media. I wouldn't say our governance is any worse than any other, major Western world. I do think it is harder to stay out of the limelight these days, whereas, maybe things, 10 or 20 years ago wouldn't have made the headlines, but now they do. And I think there's multiple reasons, but you've got to be very careful. And so, look, I think Australia's okay. I wouldn't say we're the global best standards, but are we that much worse than other nations? Probably not. But that's not based on any hard stats or statistics. That's just kind of my gut feel from what I read and kind of hear around the traps.
One quick last one. I know you consume a lot of books and various sort of media sources out there. Are there any sort of podcasts or books or newsletters or whatever they might be that scream out as being sort of fundamental, with insight or entertainment in recent times?
You're saying apart from Money of Mine?
Very flattering.
Yeah. Look, I just briefly tell you what I do. So every day, obviously, read all the newspapers, the AFR, the Australian, the Age, the West Australian. I try to listen to most of your podcasts. And I don't want to name specifics, but I like to read quality fund manager reports, so quarterly reports, mainly US based. And yeah, I've read pretty much all the Buffett books I could ever read. We've got poor Charlie's Almanac here.
A beauty.
I've read that probably 5 times. I did pick up an old Buffett book that I've read 10 times. I'm rereading it again, but I wish I could be more specific, but these days I like to read fund manager reports, fund managers, and they can be relatively new fund managers too, by the way. They don't have to be the doyens of the industry, just to keep abreast. The hard part he's working out whether it's crap or not. Like, are they a good manager or not a good manager? Because you don't want to waste your time. So in today's day and age where we all have, minds like goldfish, you've got to be very efficient with your reading.
Perfect. Thanks a lot for your time, Vas. It's been great to chat.
Great stuff, JD. Bloody a good long one. Love a good long one.
The credit's all to Vas. I love hearing how these guys think, and hopefully the money miners got just as much value from that one as I did, mate.
Speaking of value, $100 off your AusIMM Underground Operators tickets, or 190 or 160 off your GRX conference tickets. That is value, mate. Plenty of value in all these companies as well. Mineral Mining Services, Grounded, Sandvik Ground Support, CRE Insurance, K-Drill, WA Waterbores, Swick, Quattro Project Engineering, and Cross Boundary Energy. Hootaroo.
Hootaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.